We've got the starting balance and the profit ready to go. Now, do you want to tackle this step by step from the top? Or is there a specific spot in your notes you want to jump to first? Got it. Let's build this exactly like your notes. Think of retained earnings as a bucket of profit the company keeps. We start with what was already there, add what we made this year, and take out what we paid to owners. Step one is the opening balance. In your notes, it says ABC Co. had $125,000 at the beginning of the year. That is our base. Next, we add the profit. Now, look at the table in your materials. It shows profit before tax was $60,000, but then $10,000 went to income tax. That leaves us with the net profit of $50,000. We always use the profit after tax because that's what's actually left for the company to keep. So far, we have 125,000 plus 50,000. Ready to dive into the dividends? Or does that profit calculation make sense? Now we get to the part where we take money out of the bucket. First up, preference dividends. These guys get paid first. If you look at the share capital list in your notes, it says we have 100,000 $1 preference shares at 6%. To find the cost, we multiply that $100,000 total value by 6%. That gives us $6,000. Next is the ordinary dividends, and this is where students usually trip up. Your notes show two types, an interim dividend of 5 cents and a final dividend of 10 cents. Here is the rule from your notes. We only account for dividends paid or declared during the year. Since the final dividend was declared in January 20X8, it is after our December 31st cutoff. So, we ignore that 10 cents entirely for this calculation. We just take the 200,000 ordinary shares and multiply them by the 5-cent interim dividend. That is $10,000 going out. Does it make sense why we are leaving that final dividend out? You got it. Let's make this crystal clear with the formulas for every single line. Starting point is just the balance from the start of the year, which your notes say is $125,000. For the profit, the equation is profit before tax minus tax expense. From your notes, that's 60,000 minus 10,000, giving us 50,000. For the preference dividends, we use number of shares times nominal value, then multiply by the dividend percentage. That's 100,000 times $1 times 6%, which equals 6,000. And for the ordinary dividends, it is number of shares times dividend per share. We have 200,000 shares times 5 cents, which is $10,000. Remember, we only use the interim one because the final dividend happened after the year ended. Now we just plug it all into the big master equation to find what's left in the bucket. Ready to see the final total? Boom! There it is. 125,000 plus 50,000. Then subtract the 16,000 total dividends. We end up with $159,000. That is exactly what your notes show in the answer table. Before I give you those flashcards, just a quick reminder on the common mistake. Don't touch that proposed dividend. If it was declared on January 20th, it belongs to next year's report, not this one. All right, those are your quick takeaways. How are you feeling about this reconciliation now? Do you want to try a practice run with different numbers? All right, let's do a complete recap of where every single cent came from. First, the 125,000 is our base. That came straight from the first paragraph of Activity 4 in your materials. Next, the $50,000 profit. We got that by taking the $60,000 profit before tax and subtracting the $10,000 income tax expense listed in that little table in your notes. Then we have the preference dividends. The equation is the total value of the shares times the rate. We found the 100,000 shares, the $1 value, and the 6% rate all in that first bullet point under the share capital heading. For the ordinary dividends, the equation is shares times the dividend per share. We pulled the 200,000 shares from the second bullet point of the share capital and the 5 cents from the interim dividend paid line. We ignored the 10-cent final dividend because your notes specifically say it was declared after the year end. And finally, the master equation. We just take all those numbers we found and mash them together. 125,000 plus 50,000 minus both dividends. That lands us at the $159,000 shown in your answer key. Everything check out for you now? In an exam, they love to hide hints in the wording. The biggest one is dates. If you see a dividend declared even one day after the year ends, like that January 20th date in your notes, that is a huge hint to leave it out. Another hint is the word proposed. In accounting, a proposed dividend isn't a real movement in retained earnings yet because the company hasn't legally committed to it. And always scan for the word tax. If they give you profit before tax, that is a signal that you have one extra step of subtraction to do before you can start your reconciliation. Does that help you see what to look for when you're reading a fresh problem? You know where to hunt for the numbers, and you've got the radar for those exam traps. Since we've wrapped up this activity and double-checked all the steps, do you want to move on to the next problem in your notes? Or should we call it a win for today?